Everyone, let's get to some of the questions. We'll go over two today. Brennan asks, with amazing hair, Diana was very jealous, by the way. She wants to know your hair tips. I used to have long hair, but it was curly. It looked horrible 90% of the time. Says, what qualities from order flow lead to a high probability trade? Other than seeing trades close out from order flow, how do you determine when to take profits? Do you ever monitor high bid size from level 2 to take a trade? I don't look at level 2 data. I look at time and sales in the options. Remember, each option is time stamped and approved by the exchange when it's bought and sold. Level 2 is more kind of the penny stock guys. I personally don't look at it too much. I just think it could be a little bit confusing, and I don't think you really need to be honest. But what leads to a high probability trades and when to take profit? So ideally for a high probability trade, you want time, you want in the money, and you want the chart to line up with the direction. That will lead to a higher probability trade. So let's say you see, let's look at this, MSTR. Then we'll go over Peloton because they're two kind of different ballparks. These are the October 225 calls, so next week expiration, about 300K. Let's go to MSTR. The 225 calls, so they're juicy, right? They're about 680. They are, which I don't love, about $15 out the money, 13 bucks out the money, and they're very, very expensive. So I wouldn't consider this a high probability trade. If they bought like the 210s, then I would say, or even the 212 and a half, then I would say. Also, try to think of why are they buying calls? Today, the stock's up 18%. Could this just be a momentum play? And probably, yes, it is. If not, they would have bought the calls yesterday with the stock down. I mean, look, ideally yesterday would have been the perfect time to buy the call. So kind of think of, would I buy calls today when the stock's up 20 bucks, or would I buy calls yesterday when it was down? Is this proactive, reactive? And if I did have calls, let's say I owned calls yesterday, would I be a buyer or seller today? I think I'd be a seller today. I think it would be reactive. And again, I would like to see a little bit closer to the money. When you do have time, you have more leeway. So let's go over CRM, then we'll do Peloton. CRM is the 297.5 calls for next week. All right, not too far out the money, right? We don't have earnings. We don't have to worry about that. The 297.5 calls are about 220. This I would like a little bit more closer to the money. I would say the only thing I would love to see is open interest that's in the money. So high volume, I shouldn't say high volume because volume is separate, but a high number of open interest in the money calls, not the out the money calls. So out the money calls, they could be either wrong, maybe they're looking for a huge move, but a lot of these calls like these will probably expire to zero, right? Unless something major happens where the stock's over 310. And then we also have another question here that I want to get to. Let's see if we can pull them up here. There we go. From Evan. Hey, Lance, Diana. Here's a question. How when to take option positions, exit on option positions? How do you know when to take profits when following the buyers from scanners? Squeeze the position, maximize profits, overstay or welcome? What's the typical profit target? Do you wait for the whale to sell? So lots of good questions there. How do you know when to cut your losses and exits? This is particularly hard for me when I tend to hold and hope for someone else putting 100K on the line on the scanner. I assume they'll eventually be right. How to exit an option when it suddenly becomes spready when it's time to exit. That's very difficult, and there's not much you can do there with the bid-ask spread. I know how to work an order, but how do you work more aggressively and force your exit within a few minutes receiving the alert? Or do you give yourself time for the work of the order over the next hour, hoping price doesn't get away? So a lot of good questions right there. Let's first start, how do you know when to take profits, whether it be a squeeze position to maximize profits without overstaying? So let's go to the Peloton example, because this one's important, and this is a real good example, especially with the squeeze. So like Peloton, we had to order the November 6 calls today. So that's time, slightly out the money, about a quarter. Nothing too crazy, right? To be for a stock like Peloton. We know it's a highly shorted stock right here in Peloton. We know there's been rumors before. It did have a gap fill here on the chart that it completed today. but we also know, obviously, it went from almost $100 to sub $6. So today we were looking at it in the option pit and talking about it, and I just said, hey, look for a move to start to take profits over $6. Well, we hit $6, and you can see we hit $6. We had a little bit of a volume pop here, and we came back, and we eventually hit 619. Realistically, you probably could have got out 610, 612, and then we started to fade lower. So there's a couple ways. You could try to ride it and milk it, and then wait for either like a down arrow, a move over the previous low of the day. So let's say, I think it was around 570 at the time. Let's say it broke 6 and then it re-broke 6 to the downside, broke it to the upside. You go look at there. You go look at, like, I use a VMA, a 4 and 8 day variable moving crossover in the dynamic trend wave. So you see, as we broke 6, we went back in the wave. We started going sideways, and then we obviously broke lower and fading. I would just personally, and this will come with experience, I would just personally look for big round numbers a move. And when you have that kind of last volume pop, look to trim some of the position. You could leave some on, but you also have to think, do you really want to put yourself in a position where we have no volume? You see volume really dried down after this last high. You see how volume's decreasing? And then we're probably not going to do anything for the rest of the day. Because why? We get into, this was 11, now we're a little past noon. During the lunchtime hours, you usually don't have much movement. So kind of the last huff and puff was here, and volume starts to dry down. I would look also too, is there a typical percentage target? Evan asks. I would always look, and this will depend. Obviously, if you're doing a long dated trade in the money calls, you can up your position size because you're going to have more risk out there, right? You're going to have more capital at risk. If it's, let's say, a day trade or a short-term lotto ticket, like a weekly call or a weekly put option or something you're buying on Thursday, looking to sell on Friday, just something more speculative, definitely put your size at a smaller, right? Like I did Biogen calls today. I put $1,200 on the line. They were down over 50% at the open, right? It was a lotto ticket. I lost about $800 or $700 or so at the end of the day. No biggie, no harm, no foul, right? If I'm gonna put a swing trade position on, like maybe I buy like Apache, Oxy, Coca-Cola, Apple calls, maybe I'll put maybe 5,000 capital at risk. So I'll more than, triple at least, maybe even 5x or 10x, depending on the position if I really, really like it, let's say for a longer term swing trade. So I would say definitely day trades and lotto weekly options, stuff like that. Go ahead and put a profit target, like 25, 30%, 50%. You can always leave a runner on to try to get that greater, real big move. But you don't want to put yourself in a position saying, hey, what do I do the next day if the stock's dead, right? Am I going to get out? Try to be proactive, think of a game plan. Or you may be saying, all right, well, I got these, let's look at something that hit today. I got these call options in Lamb Research, LRCX. They're the November 75 calls. I got earnings in them, 10/23, so next week, next Wednesday, I get earnings. How do I want to trade this? Do I want to buy the calls now? Let's see how much they are. They're $365, so they're expensive for out the money calls, right? Do I want to buy the calls now? If they go down, let's say the market sells off and the stock goes down, let's say $1 or $2. Let's say these call options go from $360 to $2 before earnings, right? Do I want to add to them? Do I just want to bust out? Do I say YOLO and hold it through the earnings event? If so, don't risk a lot of, don't risk a huge position, because if you're wrong and they go to zero, you don't want it to hurt. But if you only have, let's say, 3 contracts, maybe, $1,000 of risk or so, and obviously, let's say you have a, 40, 50 plus K account, then no harm, no foul. You lose $1,000, you move on or so. But especially right now with so many names reporting earnings upcoming, you really have to think, do I want to hold through earnings? Do I want to take it as a day trade or a swing trade, like a lotto ticket, a weekly option? If I'm doing that or I'm doing earnings, I'm going to scale down my size so much. And maybe I look not for 25, 30%, maybe if I buy these, I'm looking to sell them at $7 or $8. I want to at least try to get a double because I'm willing to risk through the earnings event out there, right? If it's something longer dated that doesn't move so much, like let's say these coin calls, right? If I take coin calls the next week 215s, they're going to be, geez, they're juiced to the gills, $8 or so. These options are very, very expensive. Stock's up $10 today. Maybe I'm going to use a tighter profit target just because they're such expensive options, right? I know I'm not going to hit. It's going to be very rare for me to hit 100 or 200% on an $8.50 option. But maybe they go to from $8.50 to $10.50. I just take them off the table, move on, get a little slice in the pie. Maybe we have a gap up the next day, and I'm good. And that applies to cutting losses. Let's say I buy these calls on Coinbase. They're, what are they, about $8.50 or so? And let's say Coinbase Monday, Tuesday, next week does nothing. The calls go down to $7. If there's no catalyst, so let's say they go $8.50, you can see they're already moving down here. That's how quick they move to $7. Maybe I just say, you know what? I'm bored. I just want to bust out and take a $1.50 loss because there's no earnings, there's no correlated plays, there's nothing in the there's no outs where I can get that big potential double, and that applies to adding too, right? One thing that when adding to a position, you have to think, well, why is the position down, right? Let's say I get these LRCX calls, right? Let's go back to that. Or let's say Carvana here, the 210s for November 1st, right? This is a crazy stock, so Lord help us on this one. It gets earnings, right? So these get earnings. You got to go far out the money to even find them on the option chain, right? They're $6.30. $30 implied move. Let's say I buy these calls are $6.30, and let's say the market gaps down next day, next couple of days, and they go to $5, right? And I'm like, you know what? I'm real bullish on Carvana, on earnings, everything like that. Why is Carvana down? Is it down because the market's down? Is it because other names in the sector are down? That's what you need to look for, because if it's down because the market's down, it still hasn't changed, right? There's nothing different about it. If it's down because it's showing weakness and the market's up, then that should be a red flag. Let's look at one more example here in Spotify. We see, again, very pricey 360 puts. They do get earnings, though. How do you know you get earnings? Implied vol goes up about 20 points there. So, this is another example. Expensive options. You do get earnings, so you get a catalyst, but you have to think, how do you want to take it? If I were to take this, I'd probably do one or two contracts. Why? Because they're $13.50 a contract, just about. If I buy two contracts, I'm risking, about $2,700. That's a lot of money for an expensive options on earnings. And what is the final outcome? With expensive options, you don't get a big bang for your buck. And then Evan asks, how, when exiting a position, when it suddenly becomes spready, how basically to exit? That is one of the most difficult things, and that's why I try using penny wide options or nickel wide options the most possible. I would say definitely look for the first 30 minutes of the day when you have the most volume. If you're trying to enter or exit a trade during like the afternoon or during lunchtime, it could be difficult. Try using a mid-market order out there as well, and don't do spreads. You do spreads if it's like a very, very liquid stock or index, but if you're trying to do spreads like even this one in Spotify, these are still very, very wide. Like, let's say I want to do the 360, 350 bull put credit spread. I mean, that's 10% wide at least, the spread. And then you also have to get out. So that could be a 20% loss just in the spread getting in and out. So try using mid-market orders. I think that will be your best help when trying to exit a position. And then obviously try to stick with the most liquid stocks and indexes that you can find to trade. Keep sending those questions. Hit the like, subscribe, all that jazz button if they post it on the YouTube. And let me know. Great questions by Evan and Brennan.